I would like to commend Deputy Collins's proposal. The proposal would see the mortgages of insolvent borrowers written down to 110% of market value. Now, this would be one specific solution, Cathaoirleach, within the new insolvency legislation. So I'd like to illustrate for the House how this would work. Let's take an example. Let's take two borrowers, both insolvent, both with no chance of getting out of insolvency in the next 5 years. They both owe €400,000 and the houses are now worth €200,000. One borrower is a higher earner than the other. Under the new insolvency legislation, here's what would happen. One mortgage would be written down to, let's say, €220,000, which is what that person could afford to pay and live with dignity. And the other mortgage would be written down to €300,000. That person is a higher earner and would get a smaller write-down. And in a 5-year period, after about a 5-year period, the amounts that had been written down would essentially be written off. Now, there's two advantages to this. One is that both borrowers get to stay in their houses and get on with their lives. And the second is that the minimum write-down the minimum required write-down was achieved. There are, however, some very serious disadvantages to how this is going to play out. First of all, the higher earner is being penalised for being a higher earner. They're getting a write-down of €100,000 versus a write-down for the next-door neighbour of nearly twice that amount. Now, this creates a very serious incentive for the higher earner to become a lower earner, so that they too can avail of the better write-down. It leads to perceptions of unfairness, and inevitably would lead to a certain amount of resentment. Now, under Deputy Collins's proposal, what would happen is that both mortgages would be written down to €220,000. That's 10% above their market value. The main disadvantage of this is the banks would end up writing down more money than they would under the new insolvency legislation. However, there are several very serious advantages. The first is that the higher earner is not penalised for being a higher earner. The deal is more transparent because it's the same deal that everybody gets, so the banks don't need to hide who got what. Another advantage is a perception of fairness. And of course, it would be very difficult for the banks to avoid doing these. And as I'm sure the Minister has been following what's going on in the mortgage arrears crisis, the banks are doing everything they can to stay away from his personal insolvency legislation. And some of them are acting reasonably, some of them not so much. So which is better, going through the insolvency legislation or going through Deputy Collins's proposal? Well, Cathaoirleach, last year I met with some IMF officials who pointed me to recent research from the IMF, where they went back over 100 years of housing crises all over the world. And they came up with the officials said that they came up with three main conclusions. The first is governments don't tend to get involved in this stuff because it's really complicated. The second is that when governments do get involved, it tends to fail. It nearly always fails. And it fails because of perceptions of a lack of fairness. Somebody somewhere else got a better deal than I did. And because of the huge complexity involved. And the third finding from the IMF, Cathaoirleach, was that the only two examples they could find in 100 years that worked were Iceland and Norway. Iceland just a few years ago and Norway in the early 1990s. Both of those models, as evidenced by the IMF, are Deputy Collins's proposal, writing down the unsustainable mortgages to 110% of market value. So that's some serious food for thought. Now, there is an obvious challenge with Deputy Collins's proposal, which is the cost. The banks would have to write down more money. So what I would very much like to see is a cost-benefit analysis. There are clearly additional costs. There are clearly additional advantages. The IMF believe that Deputy Collins's proposal is the only one that's worked anywhere in the world in about 100 years. So I think it merits a very serious look and some very serious cost-benefit analysis, because the current process is not working. Now, I and others in the Finance Committee met recently with the chief execs of the four main lenders and with Governor Honohan. And here's what I saw. Threatening legal letters masquerading as offers of sustainable solutions with the blessing of the central bank, a huge variance in how borrowers are being treated by banks. Some of them are being treated quite reasonably, some of them are being treated very, very badly indeed, and very different quality of offers between the banks. Split mortgages that will essentially result in marginal tax rates for people who avail of them of 76% for the next 20 years. Virtually no write-down in capital, in spite of the billions and billions of euro made available for that. And mortgages being restructured in such a way that they're going to suck the cash out of the economy for many, many years to come. Deputy Collins' proposal does require more capital, but it is the model that worked in both Iceland and Norway. And unfortunately, the process as I see it evolving here is taking us down the path of Japan,
There's a minute and a half left.
where boom time debts were locked in for many years and Japan saw 2 decades of economic stagnation. Cathaoirleach, I believe while Deputy Collins' proposal is being considered, there is an interim solution which achieves the benefits of what she is trying to achieve without the huge additional capital requirements which may be required, and it's a debt for equity solution. If we go back to the previous example, here's what would happen. The mortgages would be written down to what is affordable, so not necessarily to 110%, but affordable for the 2 borrowers. The bank would take an equity stake of the difference, which they would get back basically at death. They would get back hopefully in very, very many years' time from the estate. Now the advantage is both borrowers get to get on with their lives. Critically, the banks are not going to knock on their door and say, hey, you've improved your economic situation, we're coming back and we're going to take half of whatever you got. It's transparent, it's fair, it doesn't require the additional capital from the banks. There's no potential stigma attached because the bank gets paid back in full. And critically, it doesn't encourage the higher earner to try and earn less so that they can get a better write-down. So in conclusion, Cathaoirleach, here's what I'd like to say to the Minister and to the House. Minister, I would very much like to see the government do a rigorous cost-benefit analysis of Deputy Collins' proposal on the basis that it's the model that seems to work. Secondly, I would like to draw the Minister's attention to the fact that the current process, as it is evolving in front of us, is going to lock in economic stagnation for many years, and unnecessarily. And finally, Minister, I would ask you to look at the debt for equity solution. I'd be very happy to sit down and discuss it with you. I believe it achieves many of the advantages Deputy Collins is seeking without the potential capital implications for the banks and the state. Thank you, Ciara.